leaves control. And the Bank of Israel keeping rates unchanged at 4.75% as widely expected for a fourth straight meeting, holding off on cuts in favour of financial stability amid the war. But it did cut its growth forecast for this year and next to just 2%. Marc Ostwald is live with us. He's global strategist and chief economist at ADM Investor Services for more on this. Marc, almost impossible to calculate the gross impact of the war on Israel's economy, but it seems as if the central bank is holding rates, at least for now, to try and perhaps stabilise markets. Was this the right call?
There's two different ways of looking at this. One is looking at it very much short term and looking at the impact of the war on the economy, which has been dramatic. The Bank of Israel's own monitoring indicator is down 1.1% for October. That shows the economy slowing sharply. Private consumption, business spending, all down, quite dramatically. On the other hand, it needs to look longer term. The inflation rate is still quite high at 3.7%, and it doesn't really know what the outcome's going to be. Yes, there are challenges in terms of the budget. On the other hand, it needs to try and make sure that if there is a more prolonged ceasefire leading finally to some sort of peace settlement, it could see quite a sharp pickup in pent-up demand as a result, and that might fuel inflation again. So it's probably best at the moment to do nothing, sit and wait, see how things evolve, and rather than going through a interest rate cycle which basically sees short-term cuts and then having to raise interest rates again as and when there is some sort of peace there, which might well fuel that pent-up demand and fuel inflation.